Hello everyone, I'm Mars. I'm glad to continue our discussion on the three most important financial statements in modern finance and investment banking. Previously, we talked about the balance sheet, the statement of financial position. Today, let's discuss the income statement, also known as the profit and loss statement. One thing to note is it represents a specific period, whether a year, a quarter, or even a month. It reflects all business activities within that period. So now, let's start by doing some exercises. A very important question that comes up in almost every investment banking or corporate finance interview is, how are these three statements connected? Now we know about the balance sheet, which is the statement of financial position. Now that we know about the income statement, okay, how are these two statements linked together? In order to answer this question, let's look at what the income statement is about. The most important thing in the income statement is, first, as everyone knows, sales revenue, that's your turnover. Then you have gross profit, generally calculated as sales revenue minus cost of goods sold, or COGS. In accounting, we use COGS. Then we have the EBIT. EBIT is gross profit minus SG and AMP, A and R and AMP pointing and laughing, and then minus D and AMP, A, depreciation and amortization. SG and AMP, A is selling, general, and administrative expenses, administrative costs. Sometimes, even R and AMP winking and laughing is included. After EBIT, we have pre-tax income. Sometimes, people just show EBIT, and pre-tax income is simply EBIT minus interest. Assuming a 25% tax rate, what you end up with is net income. Net income, so in this way, we've completed the whole loop from revenue all the way down to net income. It's actually pretty simple. You subtract the costs step by step, and in the end, after subtracting the so-called interest, you arrive at the final result. Then you subtract what's called tax, and that's how you get the final net income. Now, this process might seem pretty simple, but what's the key point? To put it simply, in all of finance, the most important fundamental concept is, how do you look at this? Connection is a key point. How to connect is something very important that everyone needs to understand. So, to answer this question, the simplest way to connect from the income statement is that all of the net income flows back to common shareholders' equity. That is, it flows back to equity. Because as everyone knows, equity is actually the sum of all cumulative net income, what we call retained earnings, plus what we call APIC, additional paid-in capital, plus the original paid-in capital, PIC, added together. Okay, well, PIC, I won't repeat it all for everyone now. These are accounting concepts, but the key point is that net income always flows into what we call equity or net assets. At the end of each year, this 135 will flow in. In other words, the common shareholders' equity we see now, this 1,180, already includes the 135 from these 12 months of this year. Flow into? Okay, so this 135 goes directly into the 1,180. This is just one connection. Now, another more subtle, more hidden connection is here, called depreciation and amortization. Generally, especially this part, it usually flows back to what's called accumulated depreciation. In other words, at the end of last year, it might have been 600, and now there's an extra 100 in depreciation. So, adding it up, the total accumulated depreciation becomes 700. This is another useful connection. So now you know, one connection is your income. It can flow back to equity, and another thing is that depreciation can flow to or connect to the accumulated depreciation. These are the two paths. From this perspective, of course, there's also the third statement, which we can talk about later. Now, let's move on to the second question. Right? If depreciation goes up by 10%, what changes across the two statements? Okay, this is a very classic and very common question. No matter which department you work in within the finance industry, basically 100% of the time you'll be asked a similar question. Even if you're not in the IB field, this question actually isn't that difficult. Why do I say that? If depreciation goes up by 10, so here it becomes minus 110, then let's look at it from net income. But actually, does my net income just decrease by 10 as well? Actually, that's not the case. It's simple, because when we're talking about depreciation, there's what's called a tax benefit, a tax shield, because depreciation is tax deductible. Okay, it can be deducted for tax purposes, so what do we do? That means, even though our depreciation increased by $10, what's the actual impact on net income? We have to consider the tax factor. There's a tax shield. So how do we calculate the tax shield? It's just the $10 multiplied by 25%, which is the tax rate, so that's 2.5 dollars. Alright, so what's the actual change? In other words, depreciation causes net income to decrease, but it won't decrease by the full $10. How much will it decrease? 10 minus 2.5 equals 7.5, which means our net income will decrease by $7.50, not by $10. The reason is very simple. Even though depreciation goes up by 10, within that $10, part of it is tax. Exactly, so we have a tax shield, which is a tax benefit of $2.50 or 25%. So what we actually see, okay, so what really shows up for us is a decrease of $7.50 in net income. Okay, so it's not a $10 decrease. Once we understand this, we'll quickly realize that if net income drops by $7.50, how will this be reflected on the balance sheet? In other words, eventually what flows into common shareholders' equity won't increase by 135 as much, but rather by 135 minus $7.50. Right, so that means we'll subtract $7.50 here. Okay, of course this will also affect cash, because it will impact CFO and everything else, which we'll discuss later. But for now, the direct impact is because it flows directly, right? That is, our retained earnings, which is part of equity. So our retained earnings also won't increase by 135 as much, but should be 135 minus $7.50. Alright, that's all for today. We'll continue next time. Goodbye.